Welcome to episode 14 of The Hidden History of Money. In this series, we uncover the financial stories that shape our world. Today, we turn our attention to a cautionary tale largely forgotten by mainstream finance, yet its echoes are growing louder. We're examining Japan's 1990s crash and asking a critical question. Is it a chilling prophecy for the US stock market? What lessons, both financial, political, and macroeconomic, can we learn from Japan's 1990 crash? Stay on and find out more. In the 1980s, Japan was an economic titan, its markets soaring to unimaginable heights. The boom felt permanent. And here is the unsettling truth. The very same macro signals that preceded Japan's collapse are flashing red in the United States today. Unprecedented levels of excess liquidity from central banks, the demographic cliff of an aging population putting a brake on economic dynamism, and persistent central bank distortion where artificially low interest rates encourage risky behavior and inflate asset bubbles. The parallels are eerily precise. Stay with us till the end and I'll reveal the three specific indicators that top hedge funds and macro traders are watching right now. Not just to protect their capital, but to position themselves for the next great asymmetric trade that could emerge from the volatility. Like, share, and subscribe to Finance Arcana, where we decode the hidden financial patterns of the past to profit from the future. Our Hidden History of Money series aims to help macroeconomic traders learn key turning points in history to help them generate alpha in their trades. Japan in the late 1980s, the world's second largest economy and a global titan. This wasn't just growth, it was a phenomenon. Japan Inc. entered the lexicon, a seemingly invincible model of corporate success. Tokyo's streets buzzed with an energy of limitless possibility, a belief that the sun would never set on this new economic empire. Newspapers blared headlines of record highs. Television anchors spoke breathlessly of a new era. Crowds gathered outside stock exchanges, watching tickers climb ever higher. The media painted a picture of endless prosperity, and investors, young and old, believed they were witnessing history in the making. The financial markets were the epicenter. The Nikkei stock index rocketed, doubling in just 3 years before peaking at an astonishing 39,000 in the final days of 1989. Everyone, from traders to ordinary citizens, was caught in the speculative fever. It felt like a game where the only mistake was not playing, a game where everyone was winning. The true insanity, however, was in real estate. The land beneath Tokyo's Imperial Palace was valued at more than all of California. Residential properties were selling for 500 times their annual rental income, a price that would take half a millennium to recoup. This wasn't a market driven by value, but by the pure belief that prices would only go up. What fueled this fire? Following the 1985 Plaza Accord, the Bank of Japan slashed interest rates, unleashing a torrent of cheap money. Valuations made no sense, but with credit so easy, speculation was irresistible. The infamous carry trade was born as investors borrowed yen for virtually nothing to pour into assets worldwide, inflating bubbles far beyond Japan's shores. Sound familiar? In 1990, the Bank of Japan finally blinked. But it wasn't just land prices that crashed. In 1990, the Nikkei 225, Japan's stock market index, fell like a stone from its all-time high of nearly 39,000. Within just 2 years, it had lost more than 50% of its value. Investors who believed the boom would never end watched decades of savings evaporate. It raised rates. And just like that, the illusion cracked. The news hit the morning papers, bold headlines announcing the rate hike sent a chill through the financial world. On trading floors, investors stared at stock tickers in disbelief, searching for reassurance in the numbers as prices began to slip. Television screens flickered with urgent news coverage, anchors struggling to explain the sudden shift. The word temporary echoed, but doubt crept in. Close-ups revealed red numbers cascading down trading screens, and the first signs of panic flickered across anxious faces in the room. What followed wasn't a crash, it was a slow-motion implosion. Stocks fell 80% over the next decade. Real estate never recovered. And for investors, this wasn't a blip. It was the beginning of a multi-decade bear market. For 30 years, Japan's stock market never recovered to its peak. And it wasn't because the companies were worthless, it was because the mania had detached prices from reality. Japan threw everything at the problem: near zero rates, endless quantitative easing, fiscal stimulus, but nothing worked because the system was broken from within, over-leverage. Fast forward to today, the US financial landscape is buzzing, not just with institutional investors, but with millions of retail traders, all connected in real time. Financial news channels and online platforms amplify every market move, fueling optimism and sometimes euphoria. On social media, bullish posts and viral memes spread the belief that markets only go up, echoing the collective confidence of Japan's bubble era. Crowds gather at financial seminars, and trading apps put the market in every pocket, making speculation more accessible than ever before. The US has rising asset prices despite tightening, a central bank that owns a massive portion of debt, aging demographics, and a belief that markets can't fall for long. Here's the Japanese lesson for macro traders. You don't short bubbles for being overvalued. You short them when liquidity shrinks and belief breaks. The trade: monitor Fed QT and buyback flows. So what are the canaries in the coal mine? Beyond the headlines, sophisticated macro investors are tracking three specific signals that historically precede major economic shifts. These aren't just theoretical. They are the very indicators that flashed red before Japan's lost decade began, and they're starting to flicker again. 1. Yield curve re-steepening. Forget the simple inversion, watch for the dangerous re-steepening that follows. This is when long-term bond yields rise much faster than short-term ones, a sign the market is losing faith in the future. It screams that the central bank has lost control, pricing in either runaway inflation or a deep recession. This exact pattern blindsided policymakers in Japan, as their bond market correctly predicted years of economic stagnation ahead. 2. Decline in corporate share. Buybacks. For over a decade, US companies have used buybacks to engineer higher earnings per share, propping up stock prices. But when uncertainty rises, corporations preserve cash, and buybacks are the first to go. This removes a multi-trillion-dollar pillar of support from the market. In post-crisis Japan, this corporate caution became permanent, starving the economy of investment and dynamism for years to come. 3. Foreign capital flight. The US has long enjoyed the privilege of foreign nations buying its debt, funding its deficits at low cost. But this confidence is not guaranteed. Japan saw this firsthand as foreign investors fled, triggering a crisis. If foreign buyers lose faith in US fiscal stability, they will sell their treasuries. This ignites a doom loop. Yields spike, borrowing costs explode, and the debt trap slams shut, leaving no easy way out. Japan thought their market would grow forever. So does the US. But markets don't move on belief alone. They move on liquidity, trust, and cycles. If this episode helped you think differently, like share and subscribe to Finance Arcana, because the past isn't just a memory, it's a macro setup. in slow motion. If you found this video valuable, like, share and subscribe to Finance Arcana on YouTube. Your support helps us decode more financial mysteries for you. Stay curious, stay informed, and we'll see you in the next episode. Thank you for watching Japan's 1990s crash. A warning for the US stock market. Stay tuned to our other upcoming episodes of the Hidden History of Money series.